Will a stock market drop affect my dividend payments? The quick and easy answer is no, it shouldn't, and I could pretty much stop right there. Of course, we all know things are never simple, and I don't recommend buying just any stock with a dividend, but I do believe that wisely selected dividend-paying stocks are one of the best investments in a down market. I'm Jonathan, and let's navigate this potential mess right now. Stick around until the end today because I'm going to give you specific examples during a couple different market crashes to back up the information we're about to dig into. Even though it sounds basic, and I know we have some more seasoned investors that watch here, we need to talk really quickly about what a dividend is. This is important when talking about a market crash because it plays into why they're a potentially interesting investment during that time. A dividend's a payment of a portion of a company's earnings distributed to the company's shareholders. They're typically paid in cash, and the company's board of directors decides the amount distributed. Now, the next logical question would be, what causes a company to raise or lower their dividend? The answer is cash flow. It all comes down to earnings and profitability and how much money the company has remaining after they pay for all the things that keep it running, such as salaries, research and development, and marketing. After those expenses and the dividend payment, the remaining profits go back into the company. When a company pays a dividend, its board's essentially saying that reinvesting all the company's profits to achieve further growth will not offer the shareholders as high as a return as a dividend distribution. That being said, companies offer a dividend as extra enticement for investors to buy their stock. A steadily increasing dividend payout is an indication of a successful company. We can determine that a company's steady or increasing profitability will typically lead to a steady or increasing dividend rate, and a decline in profitability could lead to that company potentially reducing or eliminating its dividends. Most U.S. companies are hesitant to reduce their dividend rates because it signals to investors that their profits are lagging, which results in their stock price getting pummeled, and that's not a good thing for their company's board or management. But if there's no change to the company's revenues or its profitability outlook, if the only indicator that there are problems is an overall reduction in stock prices across the entire market, there isn't a major reason for concern regarding dividend safety. So, with that information, what can we safely invest in during a down market, whether it be a correction, a recession, or a crash? The answer is the same that I normally talk about, with just a little more caution. You have to invest in strong companies with great fundamentals with a history of consistently increasing dividends. First, good companies are something you should always be looking for as a dividend investor. But of course, in a massive bull market, there's room to take a little more risk. In a down market, the importance of company stability is amplified significantly. We're going to look at Pepsi, ticker symbol PEP, Procter & Gamble, ticker PG, and Johnson & Johnson, ticker JNJ today. The reason I'm choosing these is for their dividend safety first and foremost, regardless of share price fluctuation. We're going to take a look at the 2001 dot-com bubble in which tech was greatly overvalued, and the recent 2020 pandemic crash to see how they affected the market and how they affected a few of our most consistent dividend players. The dot-com bubble saw an unprecedented rise in equity valuations of internet-based tech companies during the bull market of the late 1990s. Thanks mainly to speculation and substantial funding for these new internet startups, investments in dot-coms boosted the NASDAQ from 751 in January of 95 to a peak of 5,048 on March 10th of 2000. But the bubble eventually burst in March of 2000, with many companies failing to even come close to fulfilling their promise. The NASDAQ fell by around 75% between March 2000 and October 2002, wiping out more than $5 trillion in market value. So let's take a look at the NASDAQ versus our three high-quality dividend stocks. We can see that overall the dividend stocks were hedged against this massive drop. The main reason, of course, is that these were not tech stocks and were not directly affected by the overvaluations of the NASDAQ. From March of 2000 until the end of 2002, Pepsi gained 28% in share price alone. Procter & Gamble 52% and Johnson & Johnson 48% versus a historically damaging 73% loss of the NASDAQ. During that time, all three of our dividend stocks not only maintained their dividends, but increased them each year, which is exactly what we want to see. In fact, they've increased their dividends for at least the last 49 years in a row. Pepsi increased their dividends 11.1% over the 2-year time period from 13.5 cents to 15 cents per share per quarter. Procter & Gamble increased their dividends 29% over the same time period, from just under 16 cents to 20.5 cents per share per quarter. And Johnson & Johnson's increases? Insane. From 14 cents to 20.5 cents per quarter for an astronomical 46%. But Jonathan, the recent drops we're seeing are on everything. Okay, Point taken. So what happens when the market as a whole crashes, including the dividend stocks we're holding? Let's look at the pandemic market crash of 2020 just a little bit closer. It began on Monday, March 9th, with history's largest point plunge for the Dow Jones up to that date. It was followed by two more record-setting point drops on March 12th and March 16th. The stock market crash included the three worst point drops in U.S. history. It was caused by unbridled global fears about the spread of the coronavirus, oil price drops, and the possibility of a recession. Although the 2020 market crash was dramatic, it didn't last. The stock market experienced a surprising recovery, even as many areas of the U.S. economy continued to experience trouble. When we look at our dividend stocks in comparison to both the S&P 500 and the NASDAQ, we see a different picture than the dot-com bubble crash. Dividend stocks as a whole dropped on par with the overall market and recovered at a similar pace. Only Johnson & Johnson appreciated in share price from March 1st of 2020 until May 1st of 2020. But here's where the interesting information lies. If you'd sold your stocks during the crash, you would have realized a huge loss, up to 25% in some cases. If you'd held on, you would have recuperated your money over time and even made gains as we progressed into 2020 and beyond. But those investors that continued to invest and dollar cost average through the drop and subsequent rise, they saw major gains and increases in their dividend yield. As far as dividend increases go, Pepsi increased their dividends 12.5% from the start of 2020 until the end of 2021, showing continued dividend growth and giving it 49 consecutive years of dividend increases. Procter & Gamble increased their dividends an impressive 16.5%, from 75 cents to 87 cents per share per quarter, making it 65 consecutive years of dividend increases. Johnson & Johnson increased their dividends by 11.5% over the same 2-year time period, achieving 59 consecutive years of dividend increases. And keep in mind, this was all during a market crash and extremely uncertain times economically speaking. Yield benefits during a stock dip are also significant. For example, on March 1st of 2020, we see that the dividend yield on current cost for Pepsi was 2.76%. Johnson & Johnson was at 2.71%, and Procter & Gamble was at 2.5%. Within 3 weeks, the game was changed entirely regarding dividend yields. Pepsi reached 3.63%, Johnson & Johnson 3.42%, and Procter & Gamble 3.05%. That's an average 26.5% yield increase improvement at the bottom. Of course, we all know timing the market is very unlikely, but buying on the way down or the way up would have resulted in a yield between the two, still providing an added benefit. And in the end, all of these stocks recovered. So the same goes for share price appreciation. Buying during the dip or rise would have resulted in significantly larger gains than simply holding through the turmoil. To be fair, there are many dividend stocks that reduced or eliminated their dividends, but again, quality. In times like these, or even worse, we only buy quality companies. Even while stock prices are dropping, if you own strong companies with good fundamentals that either maintain or increase their dividends, you're getting paid. And if you're buying even in down times, you're getting a higher yield on cost and better future gains on share price appreciation. The final answer, you'll often see companies cut their dividends when there's a severe economic crash, but not in reaction to a market correction. Since dividends aren't a function of stock price, market fluctuations and stock price fluctuations on their own don't affect a company's dividends. And the best way to hedge against any cuts are to purchase stocks with a long history of increasing dividends through market crashes, just like the ones I gave examples of today, or to invest in quality dividend ETFs for diversity, which we didn't even touch on. Personally, I haven't decreased my buys at all. What I have done is hedge against the volatility and potential risk by being very deliberate about what I'm buying. If you got any value from today's video, pop that like button to help it get out to more people, and subscribe and click the bell to get future notifications on upcoming videos. You guys are awesome. Thanks for hanging out with me today. See you next time.